Welcome back to the deep dive. You sent us your sources, these really detailed notes on modern strategic investing. And today, we are delivering the ultimate shortcut. We are going deep, I mean really deep, into exchange-traded funds, ETFs. So if you're serious about building wealth simply, efficiently, the ETF is, it's the one vehicle you need to understand, cold. Our mission today isn't just to define it. We're going to figure out how to spot the truly good ones in what is a massive and frankly a very confusing market.
It is. It's a jungle out there.
We're going to dissect the hidden variables, like how they handle dividends, these hidden costs, that really determine if your fund is a high-performance machine or just a drag on your returns.
Exactly. And because we're, dealing with financial concepts here, we should probably start with the usual high-level reminder. Okay. This deep dive is purely for education, for information. It is not, and it really can't be, personalized financial advice. Every investment has risk, you can lose money, and what happened in the past is never a guarantee for the future. So please, always do your own research based on your own situation.
Duly noted. Okay, so let's frame this whole conversation with the quote that basically kicked off the entire passive investing revolution. It's from the legend John Bogle. Don't search for the needle in the haystack, just buy the haystack.
The whole thing.
The whole thing. That simple idea is the absolute core of the ETF, and that's what we're here to decode today. All right, let's start with the absolute basics. We hear ETF everywhere, exchange-traded fund, but what is it actually doing behind the scenes that makes it so different from just, buying a few shares of a company?
Well, the real game changer is all about replication. At its core, an ETF is just a basket of assets. It could be hundreds, even thousands of stocks or bonds or whatever, and it's designed to perfectly, well, almost perfectly, replicate a specific stock index.
Like the S&P 500.
Exactly. The S&P 500, or something even bigger like the MSCI World Index. The fund literally buys all the components of that index in the exact same proportions.
Your source material had this fantastic analogy. It said, instead of spending hours in the supermarket picking out every single ingredient for a huge, complicated meal,
right,
you just grab a shopping cart that's already filled with a perfect mix of everything in the store. You just buy the whole cart.
That's a great way to put it. And that diversification is immediate. I mean, you buy one single share of an ETF that tracks the MSCI World.
And what do you got?
You get instant exposure to something like 1,500 companies across the globe. We're talking everything from huge U.S. tech giants like Microsoft and Apple to European powerhouses like Nestle or LVMH, all the way to, I don't know, Toyota in Japan. It's instant global reach.
Okay, that makes it super accessible. But let's talk about ownership for a second. If I buy a tiny piece of that fund, do I technically own like 0.00001% of an Apple share, or is it more abstract than that?
It is more abstract, and it's a really important nuance to get your head around. When you buy a share of the ETF, it's the fund that is the legal owner of all those underlying company stocks. You are the owner of a part of the fund itself. And this structure, especially in Europe where it's regulated under something called UCITS, is a massive security feature.
How so?
It means if the company that manages the fund goes bankrupt, the assets, the stocks themselves, are ring-fenced. They're separate. They still belong to you and the other fund shareholders.
So you own the basket, not the individual pieces of fruit inside it.
Perfectly said. You own the basket.
Got it. Now, the term ETF, it's actually part of a bigger family, right? ETPs, or exchange-traded products. The sources mention ETCs and ETNs, and they flagged ETNs as being way riskier. Can you break that down?
Absolutely. ETP is just the generic umbrella term. Underneath that, you have ETFs, which are the diversified baskets we're talking about. Then first, you have the ETC, exchange-traded commodity. This usually tracks a single raw material. Think gold, silver, oil. And they're often physically backed, meaning there is, in theory, a bar of gold sitting in a vault somewhere that corresponds to your investment. It adds a layer of security.
And the ETN?
Then there's the ETN, the exchange-traded note. And this is where you have to be careful. It's fundamentally different.
Uh-oh.
It's not a real basket of assets. It is basically a debt note, a promise from a bank to pay you the return of an index. You don't own any of the underlying assets.
Wait, so if the bank that issued that note, that promise, goes bust, I'm just another creditor in line?
Precisely. That is exactly why they're riskier. They carry the credit risk of the bank that issued them. They're often used for niche things like crypto indexes, where it's hard to hold the actual assets, but you have to understand that extra layer of risk.
Okay, that's crystal clear. And speaking of clarity, when you go to buy one of these, you see two different codes, right? The ISIN and the ticker. Why two?
Right. Think of the ISIN, that long string of letters and numbers, as the unique global serial number for that specific investment. It's crucial for being 100% sure you're buying the right thing.
The one true identifier.
Exactly. The ticker, on the other hand, is the short code, maybe 3 or 4 letters. That's just used for easy trading on a specific stock exchange. But here's the catch. The exact same ETF could have 3 different tickers, depending on whether you're buying it in London, Frankfurt, or New York, or in euros versus dollars.
So, rule of thumb, always double-check the ISIN.
Always trust the ISIN, especially for a long-term hold.
All right, we know what they are, how to identify them. Now we get to the real engine room of efficiency. The sources were hammering this point home. The single most critical choice for a long-term investor is how the ETF handles dividends. This is huge for tax.
It absolutely is. This is what determines the real horsepower of your investment over time. And it splits all ETFs into 2 camps, capitalizing or accumulating and distributing.
And the sources were very clear which one they preferred.
Overwhelmingly, yes.
Yeah.
Especially when you're in that accumulation phase of your life, building wealth, capitalizing is the way to go.
Okay, so let's define that one first, the efficient one, the capitalizing ETF.
So in a capitalizing ETF, when all those hundreds of companies in the basket pay out their dividends, that cash never, ever touches your brokerage account.
It doesn't. Where does it go?
The fund manager just automatically and instantly reinvests it. They take that dividend money and use it to buy more tiny pieces of all the underlying stocks within the fund.
So it's happening, but it's invisible to me.
Completely invisible.
But
It is highly optimized. The key advantage here is all about taxes or fiscality. Since that money never officially lands in your account as income, you owe 0 tax on it. Not until the day, maybe decades from now, you actually sell your investment.
And that lets the compounding, the snowball effect, work its magic without any friction.
In its purest possible form, that tiny untaxed gain is now generating its own gains year after year.
Okay, that makes total mathematical sense. But what about the other kind? The distributing ETF. I mean, psychologically, it feels good to see that cash dividend land in your account every quarter, right? People feel richer. Why is that a bad thing?
It's a classic financial mirage. It feels good, yes, but you have to understand what's actually happening.
What is happening?
When a company pays out a dividend, its stock price immediately drops by that exact amount.
Oh.
The dividend isn't free money. It's just a transfer of value from the stock price into your cash account. It's like a tiny, hidden, forced sale of a piece of your own investment. And here's the catastrophic part, the tax friction. The second that dividend hits your account, in most countries it becomes taxable income.
Immediately.
Immediately, whether that's a 15% tax, 30%, whatever your local rate is. So even if you're super disciplined and you immediately reinvest that cash, you've still given a chunk of it to the government decades before you needed to.
So let me get this straight. In the capitalizing model, 100% of that dividend money keeps working for me tax-free for decades. In the distributing model, only, say, 70% of it keeps working for me because 30% went straight to the tax authority today.
That's it. And over 30 or 40 years, that difference is, well, it's enormous.
Yeah.
It's the difference between hitting your goals and falling short. You're just slowing the snowball down every single year for no good reason.
Wow. Okay, so the choice is clear, capitalizing. And probably a big, broad one that buys the whole haystack, like an MSCI World Tracker. The problem is, as your notes say, there are over 12,000 ETFs out there. Maybe 100 of them track the MSCI World. How on earth we filter that down? What are the key criteria?
Cost. Number 1, 2, and 3 is cost.
The fees.
The fees. You're signing up for the market's return, so the only thing you can really control is how much you pay for it. So we have to look at the annual management fees, which you'll usually see as the TER, or total expense ratio. And since these fees are chipping away at your gains every single year, whether the market is up or down, you have to be ruthless. For a big, simple index like the MSCI World, you should be looking for a TER somewhere between, say, 0.05% and 0.25%.
And anything near 0.5% is a red flag.
It's just too high for a simple index fund these days.
But the sources also mention hidden fees, these internal transaction costs. Can a fund with a low TER still be secretly expensive?
Oh, absolutely. The TER is like the sticker price. The internal costs are what the fund has to pay to actually do its job, constantly buying and selling stocks to rebalance and match the index perfectly. These costs aren't in the T-year, and they create something called tracking error. That's the gap between what the index officially returned and what your fund actually gave you. You want to fund with the lowest possible tracking error.
So cheap tier and tracks the index like a shadow. Got it. Next on the list, fund size. Why does that matter if my assets are ring-fenced anyway?
It's about longevity and liquidity. You want to see funds with at least hundreds of millions, ideally billions, under management.
Why?
Because if a fund is too small, say under 100 million, there's a real risk the provider will just shut it down or merge it. And that can force you to sell and trigger a tax event you weren't planning for. Bigger is just safer and easier to trade.
Okay, let's get into the most technical one, because it always confuses people. Replication method. Physical versus synthetic.
Right.
I mean, synthetic just sounds like some kind of financial engineering that's waiting to blow up. Why would anyone choose that?
It's a totally natural reaction. And you're right, a physical ETF is straightforward. It really does buy and hold the actual stocks. A synthetic one, it replicates the performance using derivatives, usually a swap agreement with a big bank.
So it has that counterparty risk we talked about with ETNs.
It does, yes. But, and this is a big but, in Europe, these funds are very strictly regulated under those UCI's rules. They require collateral to be posted to protect investors.
But still, why take the risk at all? Why not just straight to physical?
Because sometimes regulations force your hand. For investors using certain tax-advantaged accounts like the French PEA, for example, there are rules about what you can hold. A physical ETF holding U.S. stocks might not be eligible. So a synthetic ETF becomes the only compliant way for that investor to get exposure to the U.S. market inside their tax-efficient wrapper. It's a regulatory workaround that gives you huge tax benefits.
So you're trading a tiny, regulated counterparty risk for a massive, guaranteed tax advantage. That's a powerful trade-off.
Exactly.
Okay, last two quick ones. Currency. If my ETF is listed in euros, but it holds U.S. stocks in dollars, does the listing currency actually matter?
Not really. Only a tiny bit when you buy or sell. The underlying performance will always reflect the real currency movements between the euro and the dollar anyway. Don't sweat the listing currency.
And finally, eligibility.
The most basic one. The best ETF in the world is useless if your bank or broker doesn't let you buy it. Always check that first.
Okay, so to recap the filter, we want something simple, cheap, big, capitalizing, and that actually fits in our investment account. What are the big picture advantages that make these things so perfect for, well, almost everyone building for the long term?
The number one advantage is immediate, cheap diversification. With one click, you basically eliminate the risk of any single company failing and taking your portfolio down a bit.
If one company fails, the other 1,499 are there to compensate.
Precisely. And you don't need to spend your nights reading balance sheets. You just buy the entire economy's growth.
And the fees, compared to old school mutual funds, are just worlds apart. We're talking maybe 0.1% versus 1 or 2% for an active fund. That difference, compounded, is life-changing money.
It really is. Plus, they're super accessible. You can buy fractional shares for like €5 now, and they're secure. And the ETF itself cannot go bankrupt.
So if they are so efficient, cheap, and diversified, what's the catch? What are we giving up by just buying the whole haystack?
You're giving up the chance to beat the market. That's the deal.
Right.
It's by definition, if you buy the index, you will only ever get the index's return, minus your tiny fee. You're signing up for the average. Now, historically, the average has been very, very good, but you will never have that one stock that goes up 50% in a year.
And there's still market risk. If the whole market drops 20%, your ETF drops 20%. And crucially, you mentioned a kind of hitting risk, concentrated risk.
This is a really critical point right now. A lot of the big global ETFs, like the MSCI world, are actually heavily, heavily weighted towards U.S. companies.
And within the U.S.
Within the U.S., the performance is driven by a handful of giant tech companies.
So you think you're diversified across 1,500 companies, but if, say, U.S. tech giants have a bad decade, your whole global portfolio takes a massive hit.
Exactly. The risk is still concentrated in one country and one sector. It's the paradox of modern indexing. You've gotten rid of specific company risk, but you still have this big macro concentration risk.